This example begins with a long-term uptrend being corrected by patterns within patterns. First, there is a double top that has the less common feature of a gap in between the downswings, rather than the more common variant of gaps before and or after a double top. After the gap down, a wider range forms a flat bottom that demonstrates elements of double and triple bottom ranges to form the lower boundary. The mid-90s range gains extra significance because it is the site of a sharp bullish peak in October. There was also a triple top from July to August that presented a slight incline to outline a failed ascending triangle. The old uptrend lines become the focal point of attention when a failed inclined double bottom transitions to a bearish continuation. Other than the inclined W outline, there weren't any bullish features. Bullish volume was mainly at normal levels, while the beginning and end of the pattern had small gaps and red volume spikes. There was even a bearish spike for the middle downswing to add to the likely break of the uptrend lines. When just counting individual candle patterns as swing points, there is technically a triple top, then double top, followed by a single regular downswing in the 87 to 86 range from December to May. However, they can all be combined to form the upper boundary of a failed ascending triangle and the general outline of a triple top when just counting each small individual downtrend as individual bearish reversal areas in the long term. Validation of the uptrend lines increases even more when they are precisely the site of multiple downswings. Most noteworthy here are the two large red candles in June. They have opening prices almost directly on the upper trend line during and after the failed double bottom completes. Later, the 83 to 80 range goes from a gap down range to another upper boundary in a failed ascending triangle. Together, the outlines also form a failed reverse head and shoulders, all of which add to the great resistance potential seen at 80 into late January 2018. Even though this triple bottom had valid features including the secondary feature of flat price action before the main pattern outline formed, it failed as bearish volume and price action developed a downswing even before the gap down. The gap down represents the final exhaustion of the larger downtrend with a short-term bearish overextension. Then selling volume mainly stays at normal levels. The gap down fill still temporarily pauses the new uptrend, which has its uptrend line adjusted to incorporate the most upswings. Penetration of the candle on October 11th under the regular uptrend line is acceptable since it had high volume. Here is a great example where a normal head and shoulders reversal finishes with an extra acceleration due to classic 3 methods falling price action. There is even a gap down to break under the stronger support potential of the neckline and uptrend line intersection. A bearish continuation soon takes place with a characteristic neutral to bullish range before the next downswing accelerates into March. Interestingly, there is the approximate outline of a minor head and shoulders with flat and distorted shoulders that still do have clear swing points. The next bearish continuation also has the neutral to slightly bullish price action and the benefit of a minor double top for a greater drop. Similar to the last significant downtrend, bearish volume begins to subside after the gap down, and only returns to exceedingly high levels when the gap is filled. Here the upper 50s range had influence in opposing the gap fill, since it presented clear resistance potential. The bullish spikes into November helped overcome this obstacle. Sustained resistance at the gap fill range bolsters the established downtrend even more. This case study has been a good demonstration of mostly successful bullish reversals and failed bullish continuations that end up being relatively small within a progressively stronger downtrend. Often, it is intuitive to understand bearish retracements in a stable uptrend. However, it is less natural to think of regular bullish retracements in a sustainable and aggressive long-term downtrend.